Now the second method is share-to-share exchange. Share-to-share exchange. B, share-to-share exchange. Share-to-share exchange. Share-for-share exchange is another method that a company may use to finance mergers and acquisitions. Now, when discussing the financing of mergers and acquisitions, a share-for-share exchange is a crucial method to understand before settling on which method to use. Companies have to consider the share-for-share exchange method. And in essence, share-for-share exchange is a transaction where the acquiring company offers its own shares to the shareholders of the target company in exchange for their existing shares. Share-for-share exchange. It's self-explanatory, is it not? The acquiring company offers its own shares to the shareholders of the target company in exchange for their existing shares. So if company A is acquiring company B, so this is the acquirer and this is the target, the predator. This company has shareholders. This company has shareholders. This company is buying company B. This company B is owned by existing shareholders. So instead of paying the existing shareholders cash, as we saw in the first case, this company can offer its own shares to company B. Because once company B is acquired, this company ceases to exist. So instead of these shareholders being granted or given cash, they become shareholders of company A by virtue of the shareholding that they receive in exchange to their existing shares. So they have to relinquish their own shares in company B, and for them to relinquish these shares in company B, they are given company A shares. The acquiring company offers its own shares to the shareholders of the target company, and that is in exchange for their existing shares. So they are not given cash, they are given shares of company A, the acquirer. And that means that instead of receiving cash, the target company's shareholders become shareholders of the acquiring company, to put it differently. And a critical element here is the exchange ratio. Okay, there has to be a ratio. A critical element in share-for-share exchange is the exchange ratio, which determines the target company. You understand? The exchange ratio, which we will be learning how to calculate later on, but you have to get that understanding. You need to understand what is a share-for-share exchange. Now, one of the key features of share-to-share exchange is that it is equity-based. This method is equity-based. we are talking about share-to-share exchange. It is equity based. It's based on equity. The method primarily involves the exchange of equity rather than the exchange of cash or debt. Another feature associated with what is dilution. Another feature associated with the exchange, the share-to-share exchange, is dilution. Now, the acquiring company issues new shares, which then dilutes the ownership percentage of its existing shareholders. If, for example, there were only 10 shareholders, when new shareholders are introduced, say 20 shareholders are introduced, then there is dilution of shares. There is dilution. The existing company, after issuing new shares, dilutes the ownership percentage of its existing shareholders. So these ones were holding equally, say equal, maybe each is a tenth of the shareholding. When you have 20, they will no longer be controlling, each shareholder will no longer be controlling 10%. The percentage will be diluted by virtue of having many shareholders in the company. Dilution. Another feature associated with the share-to-share exchange is the aspect of valuation. Valuation. Accurate valuation of both companies is essential in order to determine a fair exchange ratio. The companies must be properly valued in order to have a fair exchange ratio. There could also be tax implications. In some jurisdictions, this type of exchange can be structured to be tax-deferred, which can be a significant advantage. Now, why would a company then prefer share-to-share exchange and not outright cash or share-to-debenture exchange? Why do we have some companies preferring share-to-share exchange? That is a question that we may want to answer. Companies use share-to-share exchange in mergers and acquisitions for various strategic reasons. And the reasons are structured around financial flexibility. They are structured around alignment of interests and also tax advantages. One reason is to conserve cash. Companies would prefer share-to-share exchange as opposed to outright purchases in cash in order to conserve cash. That is the primary reason. The primary reason a company will opt for share-to-share exchange is to conserve cash. Instead of paying cash for the target company, the acquiring company offers its own stock. And that is especially important for companies that want to preserve their financial resources. So that instead of paying the target company, that money can be invested. That's one reason. Another reason is associated with large acquisitions. Large acquisitions, another reason. Now, large acquisitions, a cash purchase might be prohibitively expensive. which makes share for share exchange a more viable option if you have a large acquisition. If the target company, if the acquirer is to pay large sums of money to the target, the only viable solution will be share to share exchange. Yet another reason is aligning of interests. Aligning of interests. Aligning of interests. Now, when the target company shareholders, for example, receive shares in the acquiring company, they become shareholders in the combined entity. And that aligns their interests with the acquiring company's interests, which then encourages them to support the integration process. You understand? Yes. Because they are now part of the ownership of the acquiring company. To align the interests of both the target company and the acquiring company, the share to share exchange method is preferred. Tax advantages. Now, candidates, in some jurisdictions, a share for share exchange can be structured as a tax-deferred transaction. It can be structured as a tax-deferred transaction, which means that the target company's shareholders do not have to pay capital gains taxes until they eventually sell the shares of the acquiring company. Deferred, that's why I refer to it as deferred. It is a tax-deferred transaction. Tax-deferred transaction. Because it is a share to share exchange, the shareholders of the target, as opposed to the cash method, they are not required, may not be required to pay capital tax gains after selling off the company. They may be required to to pay tax gains after selling the shares that they receive from the acquiring company. So that is another reason. There are no capital gains taxes that are paid when this transaction is being carried out. And that is a tax advantage. That tax advantage is attractive to the shareholders. It makes the deal more attractive to the target company's shareholders because it allows them to defer paying taxes on their gains. They gain by joining the acquiring company without making any taxes, without paying taxes. So that's an advantage. That is a reason. Reason one is conservation of cash. Number two, we've said it aligns the interests of the shareholders. Number three, we've seen it has tax advantages. Number four, the fourth reason why share to share exchange is attractive is flexibility in negotiations. There is flexibility in negotiations. Offering shares can be a flexible transaction tool, allowing companies to structure deals that meet the needs of both parties. Because using shares can help when there are disagreements on valuations. If there are any disagreements on valuations of both the companies, the disagreements can be resolved when financing using share to share exchange method. You understand? That it allows for flexibility in negotiations because the target company shareholders are not being paid off and they go away. No, they still become part of the new entity. They become part of the shareholders, the owners of the acquiring company. So it becomes very easy to negotiate or to iron out any disagreement that may arise during valuation. Understand? There is also another reason. It maintains financial stability. Financial stability is maintained. You understand? Share for share exchange prevent the acquiring company from having to take on large amounts of debt. So these are the advantages. These are the reasons why share to share exchange is preferred or may be preferred. But does that not mean that this method does not have disadvantages? There are also some disadvantages that are associated with or challenges that are associated with the method. So what are the disadvantages? Now the first challenge of share to share exchange method is dilution of ownership. Dilution. It's obvious. Dilution of ownership. Issuing new shares dilutes the ownership stake of the acquiring company's existing shareholders. That is obvious. There could also be valuation challenges. 2, valuation challenges. Valuation challenges. Determining a fair exchange ratio can be complex and contentious because it requires accurate valuations of both companies. And there could also be fluctuations in stock prices which can further complicate the process. Market volatility is another disadvantage. Market volatility. The value of the shares received by the target company's shareholders can fluctuate, which creates uncertainty and potential losses. Complexity. Is a challenge. How is complexity a challenge? Share for share exchange can be a complex transaction which requires careful legal and financial planning. There is dependence again on stock performance. E, dependence on stock performance. Dependence on stock performance. The value of the deal is tied to the performance of the acquiring company's stock. And if the stock performs poorly, then the deal becomes less valuable to the shareholders of the target company. So candidates, that's all we can say about the share to share exchange. We highlighted the features, the advantages and the disadvantages.